Greetings to everyone. Welcome back to Raku Media. In today's session, we are going to continue what we did the last time on consolidated statement of financial position. Right. So today we are going to talk about we are going to do in a situation where there is what an intra-group transactions, like let's say a parent sold to a subsidiary and also a subsidiary sold to a parent. So we are going to know how to treat those kind of transactions and then how the statement of financial position is going to look like after that situation. So we will look at adjustment for pre and post acquisition reserves. We also look at fair value adjustment. When we are done, we will solve a question here. We will solve this question to clear things up. Let me try my possible best and do this within 1 hour. All right. So pre and post acquisition reserves. So reserves of subsidiary that exist on the date of purchase are pre-acquisition reserves and forms part of the goodwill, which we did in the previous video, right? They do not appear in the consolidated statement of financial position as distributed reserve. So those reserves that were there before there was an acquisition, they do not appear as what? Distributed reserve. Profits and losses of subsidiary made after purchase, which is the post-acquisition reserves or losses, may be distributed. So you remember we distribute the post-acquisition profit when we see that the pre is less than the post-acquisition, right? Then we find the difference and then distribute the profit. So positions within earnings figure, in our example, thus far, we have not dealt with any acquisition reserve. So far, let's look at this example where at the pre-acquisition, we normally look at the subsidiary side, the parent in there. So this was it here, non-current asset. They also had net assets here, making a total of 14,000. Now, you can see that the share capital is also worth 10,000 and the retained earnings is worth 4,000. Now let's look at the post. Now, non-current has increased to 12,000, which it used to be 11,000. It has increased to 12,000. Now, net current assets is now 4,000. And then this has caused our retained earnings to increase from 4,000 to 6,000, right? So that's what we are seeing here. So now, if we want to calculate the post-acquisition profit, it is going to be the pre-acquisition here minus the post-acquisition, and we are going to get like 2,000. All right, that will be our post-acquisition profit. We've done this already in the previous session. So, let's run away from this side and then know all this. We did it in the previous video. So let's look at where we are going to. All right. So this is our main topic. So pre-consolidation adjustments, right? Before we do the consolidated financial statement, financial position, we have to do these adjustments when there's an intra-group kind of transactions. But also there are some things that can arise when we don't even do intra-group transactions. So we have the fair value adjustment. This is a situation where asset has either increased in value or reduced in value. So if asset has reduced in increase in value, especially when it's a fixed asset, you add the we will make sure we increase that asset in the statement of financial position, and also we make sure that we calculate depreciation on that part that has what increase in value. We should also note that retained earnings is going to increase by the revaluation amount. So we are going to treat that one too. And then it will also decrease by the depreciation that we will calculate. We will do some soon. So we have the pre-acquisition dividend where there is no need to adjust it on cost of investment now due to amendment of IAS 27. We will have intra-group transfer of fixed assets. Just think as, let's say, Legon, our school is having different classes. Let's say you transfer a chair from one class to the other. Would you treat it as you buying an asset? No, right? It is just a transfer. So if in case it has been calculated as, let's say, purchase, then we are going to make sure we cancel that kind of transaction. Then we also have intra-group trading, where there might be some kind of profit. You bought a good at, let's say, 10 cedis, your subsidiary bought it at 10 cedi, and then sold it to you. No. Let's say the parent bought it at 10 cedi and sold it to the subsidiary at 12 cedis. Meanwhile, it is still in the group, right? We have to find ways and means to what? Eliminate that profit. Then current rate group. So current account. So if, let's say, one of the groups are owing, let's say parent is owing subsidiary or subsidiary is owing parent, it is still in the same group, and we don't need to keep that. So you have to find ways and means to eliminate that. Then dividend payments. So there. So now we are coming to talk about it one. So whatever we are coming to talk about now, I've summarized everything already. So I'm coming to move fast tomorrow. So in order to calculate goodwill accurately, the assets of the subsidiary company must be valued at a fair value. That is, the amount for which assets would be exchanged between knowledgeable and willing parties in an arm's length transaction. This is actually a Boateng's favorite word every day, arm's length transaction. I like that. All right. So if we want to calculate the fair value in the question, for example, they will give it to us that maybe the asset has increased in value by this amount or has reduced in value by this amount. So it can also be based on the fair value, based on market, or depreciated replacement cost if no market value available. So if in the case of intangible asset to evaluate based on the fair value of the market and also the best arm length estimate if no market value. So meaning that how much you'll be able to sell it if there is no market value. Now, how to calculate fair values? The same thing. Inventories to finishing goods. For finishing goods, is going to be the selling price less cost of sale and reasonable profit, right? And also for work in progress, it's going to be, and these stuffs are not really done in here, but let me just go. So work in progress is going to be selling price less cost to complete, then cost of sale and then reasonable profit. Then raw materials is going to be a current replenishment cost. Now, so monetary assets and liability example are loans, interest payables, trade payables, receivables, cash at bank. Amount to be received or disbursed, right? First, then secondly, discounted if significant by the time value of money. These are all the marketable security, non marketable security, and the like. So now this is what we need to actually focus on. So intra-group transfers, a parent company and its subsidiary often engage in variety of transactions among themselves. For example, manufacturing company often have subsidiaries that develop raw material or produce components to be included in producing. So that's what I've just said. Okay. All aspects of intra-group transfer must be eliminated in preparing consolidated financial statements so that the statements appear as if they were of those of a single company. Once the conditions for consolidation are met, group members become part of a single economic entity and all transactions with related companies become internal transfers that must be eliminated fully. regardless of the level of ownership held. So IAS 27 requires intra-group balances from trading, sales of assets, and dividend payment to be eliminated fully. So if you pay dividend to your other member, it's supposed to be eliminated fully. When you sell assets to the other ones, it's supposed to be eliminated fully. As I said, for example, moving a chair from one class to the another is still, the chair is still in the same school. So we don't need to say that we've purchased a chair to another class or something. Then, in particular, profits made between of between members of the group are not realized and cannot form part of the consolidated income statement, right? So any profit that is made within the group, I sold to parent, sold to subsidiary, and made profit, right? On a profit, we need to eliminate that profit. If parents and group members accounting is up to date, then if one company buys goods from another, the same economic transaction will appear in both accounts. In one as a sale and the other as purchase. If parents and group members accounting is up to date, then if one company acquires non-current assets from another, the same economic transaction will appear in one as a disposal and the other as acquisition. If parents and group members accounting is up to date, then if company buys on credit or takes loan from other, the same economic transaction will appear in both companies. So I've given a summary about this. So intra-group sales at no profit. So where there is sales at no profit, then selling company records the sale and reduces inventory. Then purchasing company records the purchase and increase inventory. Inventory moves from one company to another, but remains in the group. So there is no overall change, right? So the journal will be like this. We debit the group sales 15 CD and 50, let's say 15 CDs. And also we credit the purchase at what? 15 CDs. So where there is profit or loss from selling an item to a related party group member is normally considered realized at the time of the sale from the selling company's perspective. Upon reflection and remembering the single entity idea, the profit is not considered realized for consolidation purposes until resold to an unrelated party. Well, firstly, the selling company has recognized profits on goods that it has sold, but still remain in a group, right? So this profit is unrealized from a group point of view, and so must not be recognized. So you can't trade among yourself. Secondly, the inventory held by the purchasing company is being held at the price that it's paid, which from a, which is from a group point of view effectively includes an element of profit. So we need to try and then bring it out. So this is an example, but we don't care about this. So now where intra-group sales at profit and unrealized profit on unsold inventory. So let's say you sold an inventory to a subsidiary or a parent, and then that parent also has sold some already. So let's say you sold a good to the parent, and then the profit that was on it was uh, let's say 900 cedis profit, right? And then now that parent who has also sold some already, right? Maybe he or she has sold half of it. Now, the profit now on it is left, it was 4,500. And that 4 times 500 is now what is supposed to be adjusted in the group and not that full 900. So we will treat something like this very soon. So unrealized profit elimination. So when a sale is from a parent to a subsidiary, namely downstream sales, any gain or loss on the transfer accrues to the shareholder of the parent. When a sale is from a subsidiary to its parent, namely an upstream sale, any gain or loss accrues to the shareholder of the subsidiary. If the subsidiary is wholly owned, all the gain or loss ultimately accrues to the parent company as the sole stakeholder. If, however, the selling subsidiary is not wholly owned, the gain or loss on the upstream sale is apportioned between the parent and the non-controlling shareholders. If the sale is a downstream transfer, all the unrealized profit is eliminated from the controlling interest share of income when consolidated statements are prepared. If instead the intra-group transfer is from subsidiary to parent, the unrealized profit on the upstream sale is eliminated proportionately from the interest of the controlling and non-controlling interest. So we will do something like this very soon. So uh, turnover is defined as the sales third parties. Intra-group sales must be eliminated. So in case there is any intra-group sales, it must be eliminated. Now, in the consolidated income statement, profit on intra-group sales is unrealized. Where we will do income statement very soon. I'm starting with the statement of financial position. That's one. So the sales is unrealized and such profit may not be recognized in the consolidated income statement. So in the consolidated of statement of financial position, inventory must be at cost to the group. So the cost at which the inventory was purchased. Profit is only recognized when goods are sold outside the group. So during the, let's say example, during the full year, Paul sold to Simon for a total of 300 Ghana cedi, 3,000 Ghana cedi, which represented a cost plus 25%. So the cost is there and then they've added 25% to it. At year end, half of these goods were still in Simon's stock. Eliminated. So sorry, eliminate the unrealized profit by reducing the consolidated statement of financial position inventory values, meaning you are going to credit and then the consolidated profit, you are going to debit it. So this is how it is treated. You find the margin on it. So margin is going to be 25 over 100 plus the 25%. You are going to get a margin of 600 cedis, right? And then we are seeing that half of the goods here are still in stock at the end. So meaning they've sold half already. So you find that half of that profit, then it is left with this, right? So we have to reduce the inventory by this 300 to reflect the cost. Now, since we are done with whatever we need to do or we need to know about group adjustments, let's take a question and then kill this show. So this is a question here in our tutorial set. The following statement of financial position is from Pinkra and Asamoah, and they are available. So statement on financial position as at 1st October 2019. Non-current assets totaling 525,000 for Pinkra, and then for Asamoah 120,000. Now shares in Asamoah at cost is 200. Now our current asset is totaling 465 for Pinkra, and then 175,000 for Asamoah. We have a total of what 1190, and we have a total of 295. Now our equity will be when we come to our equity and liability side, we start with the stated capital. Stated capital for Pinkra is 700, and then for Asamoah is 170. Income surplus for Pinkra is 215, and then for Asamoah is 50. This leads to a total of 915 for the equity side and 220 for this one. Now, current liability totaling 275 here for Pinkra and then 75 here for uh, Asamoah. Now we have the total rate as balance here. All right, so the following information is available. Pinkra purchased 70% of the stated capital, which we know here to be 170, right? Shares of Asamoah 4 years ago, when the income surplus was 20,000. There has been no impairment of goodwill. For the purpose acquisition, plant in Asamoah with a book value of 50,000 was revalued to a fair value of 60,000, right? So you see, the revaluation was not recorded in the account, so we have to record it. And depreciation is charged at 20%. I told you that whenever there is revaluation, there is also a depreciation using the straight line method. So Pinkra sells good to Asamoah at markup of 25% at October 31st, 2018. The inventories of Asamoah included 45,000 of goods purchased from Pinkra. So we have to find the margin on this. We have to find the margin on this and then work with it. So Asamoah owes Pinkra 35,000 of goods purchased, and Pinkra owes Asamoah 15,000 of goods purchased, right? So it is the group policy to measure non-controlling interest at fair value. The market price of the share of the NCI shareholders just before the acquisition was 1.5, right? So now they say we should prepare the consolidated statement of financial position of Pinkra as at 31st October 2019. All right, so let me do this in Excel. Remember, when it comes to this, we always start with a group structure, right? So workings one, group structure. So for group structure, they purchase Asamoah, right? So Asamoah will come here. Now, they purchase 70%, which was stated in the question, and then to be left with 30% for the NCI. So this means that Pinkra has 70% shares in Asamoah, and the NCI is what? 30%. Now we indicate our date of acquisition. Date of acquisition is going to be 1st October 2018. Then date or reporting date is going to be 31st. Let me see the date of acquisition. Well, okay, so looking at this, the date of acquisition is going to be 1st November, right? So this is 31st. So the date of acquisition is going to be 1st. Yeah, that's what we have here. And the reporting date is going to be this one. All right, so this is the group structure. You do this, you get your marks, right? Now let's move to 2, where we calculate the net assets of the subsidiary. Rich, the net asset of the subsidiary. The subsidiary here we have is a someone. So we will have at acquisition and then at reporting. So remember, we start with equity. At acquisition, it was 170,000, right? Let me put 3 zeros at the top here. It was 17,000. It was 170,000. Then you had an income surplus of or retained earnings. So it was purchased when the income surplus was 20,000. So income surplus here is 20. Then on acquisition, we saw something here. For the purpose of acquisition, plant in a someone with a book value of 5,000 was revalued. So meaning that during acquisition, this plant was revalued, right? So revaluation is going to be 10, right? So then I think that's it for this one. Then at reporting, we're still having the same 108,000 here. And then our income surplus increased to 50, right? We were having 50 income surplus, so we bring it. Our evaluation still remains the same to be 10. And then, mind you, I told you that since whenever there is a revaluation, there will be depreciation, right? And depreciation will be calculated in the next year, right? So depreciation will be calculated for at the reporting date. So remember, they told us that depreciation is 20% on a straight line method, right? So now we need to calculate our depreciation. So now, this is where we take for something was said here that The thing was purchased 4 years ago, right? So this is where we take that into consideration. The depreciation is going to be the 20%, 0.2 times the 10 times 4, right? And we are going to get, we're going to get 8. And this 8 will be subtracted. So minus 8. Now, let's calculate for our profits. Here is going to give us 2,200. And here is going to give us 222. Now, our post-acquisition profit, PAP, is going to be into brackets 222 minus 200. And we are going to get what? 22. Right, so we distribute it among them. So parent share is going to be equal to 0.7, which is 70% times 22. Now, the subsidiary share is going to be 30% times 22 is this. All right. Now, we are done with this. Come on, let me run this. All right. So this is what we get for the parent. It has been rounded. So this is what we get for the parent, and this is what we get for the subsidiary. All right, so we move on to workings 3, which is the computation of goodwill, right? Now, see, now computation of goodwill at acquisition, we start with our purchase consideration. So the purchase consideration here And the question was investment in Asama is 200. So that's the purchase consideration for 200. Then we add the value of NCI. All right, so NCI, which is going to be 0.3 times the 170 that is in the balance sheet times 1.5. The reason being this is that, see, they were having a total of 170 shares, 170,000 ordinary shares, right? And then Pinkra has purchased 70% of it, so it will be worth 30%. So that's the 30%. That's why it is 0.3 times this. And then we are told to value NCI at fair value. And we are giving the fair value here. So the market price of the shares of the NCI shareholders just before acquisition was 1.5. So we have to do it this way. That's why we are multiplying it by it. So this is going to be 0.3 times 170 times 1.5. And we had 77. Now we add, we're going to get 277, right? Then we less net assets at appreciation, which is in working 2. Net asset at acquisition here is what? 20. Hey, 200. So bring it to 200. Then when we less it, we are going to get 77. And this will be our goodwill. The reason why this is straight going to be our goodwill is because there is no impairment. If there were to be impairment, like we are going to subtract the impairment from it and then treat it. But here they were saying that there has been no impairment of goodwill, so we keep it like that. Now we are done with the computation of goodwill. We go to the workings for, which is the NCI computation, right? So NCI computation, which is going to be the fair value of NCI, which we did in workings 3. Right, the fair value was 77. Then we add the share of PAP post acquisition profit. So here is in workings 3. And then here is in workings 2. Now the PAP, the share of post acquisition profit for the subsidiary is what? 7. So 7 is here. And when we add, we are going to get 84. And so this is the fair value of the NCI. Now we have to go straight to the group retained earnings. That will be our last workings, right? But there is some adjustment that we are supposed to do. So let's do that adjustment and then put it in the retained earnings. So intra-group adjustments. And this is our main topic for today. That's what we just did today. Right. Let me now put it here as 5. We know it's not part of the 5 basic workings, but I'm just putting it here. Now, remember that in the intra-group, in the group, there was something like Prinkar sells goods to Asamoah at a markup of 25%, and the inventories of Asamoah is having 45,000 of that goods that was purchased, right? So you have to calculate the markup on that particular good, right? Then what you are going to do is you are going to what? Subtract it from our retained earnings, right? That is going to be a profit, an unrealized profit that we are having. So unrealized profit, which is basically going to be, remember the markup rule, right? 25, since it is 25, 25 over 125 times the value, this 45,000. So now we are going to have it in here. So that's going to be equal to 25 divided by 125 times 45, because here 3 zeros is already at the top. And we are getting 9. Now we are supposed to also do the same thing for the inventory of someone, because we are saying that this is included in the inventories of someone, so you have to take off that profit. So which is also going to be the same thing, 25 divided by 125 times 45,000 equal to, so what we are going to do is we are going to credit, no, we are supposed to, rather, the retained earnings normally have credit balance, right? It has a credit balance, so we have to debit retained earnings. So we have to credit inventory to reduce it, and also debit retained earnings with this unrealized profit, right? So now there is also some other transactions here that we need to talk about here. Asamoah owes Pinkra 35,000 for goods purchase, and Pinkra also owes Asamoah 15,000. So what do we have to do? We have to, let me bring it here. So we also have receivables, right? So we are going to reduce the receivables. Receivables will have debit balance. So we are going to credit receivables with the amount, which is going to be 35 and then 15. And then 15. And we are also going to debit payables with 35 and then 15, just to cancel the thing that they are owing, right? So equal to, all right. So now we are done with this intra-group adjustment. Then the next thing we are supposed to do is a group retained earnings. The group retained earnings, as this thing is saying, is what group retained earnings. So we start with the retained earnings of the parent. Right? And then the increase retained earnings is is 215. Bring that same thing here. Then you have share of PAP. So the share of PAP that we did here in working is 2, is 15. Then this intra-group adjustment here, this profit that was unrealized is supposed to affect this. So we are going to less unrealized profits. The reason why we are lessing everything here is because of Pinkra, which is the parent, rather sold to Asamoah. If Asamoah should have sold to Pinkra, then we are going to apportion it, right? As we spoke about this when I was explaining. But here is the case: it's Pinkra rather that sold to this a downstream, right? So it is treated like this, right? So minus 9. Now let's sum everything. Now our group retained earnings is what? 221. Since we are done with all the workings, then consolidating will be easy, right? So let's consolidate. consolidation again, and Ankasakra is just adding keke. So Pinkra, if something like this comes in exams, you did you, but when you win a baby exams, why? These are similar, but a lot bulky. So now we start with our non-current asset, right? NCA. Still, we have the 3 zeros at the top. We have our plants. Now, we are going to add the two of them. So we add the plant of Inkra and then the plant of Sama. 325 plus 270. 325 plus 70. Now remember there was what, a revaluation from 50 to 60, right? So meaning that difference was 10. So we bring it. And then we also worked for depreciation and we take that depreciation out. And we are going to get 325 plus 70 plus 10 plus minus 8. Then we come to fixtures. If you can't do anything, boy, the consolidation, the only way to do such shape, right? Then the fixtures too was 200 plus 50. All right. So now we now move to the goodwill that we saw. So goodwill will come, and goodwill, what did we get? We had 77 for goodwill. Yeah, which was working 3. I think that's all the assets now. Close it. And this is our total current assets. Let's move to current assets. Start with our inventory. Now inventory is 224 in car and then 70 for someone. Remember we did some adjustments, right? Where we said we'll take 9 out of it, the unrealized profit. So we take it out. Now it is going to equal to 290 minus 981. Then move to our receivables. Add the 2. 145 plus 105. Remember, we did some adjustments at the top, right? We did some intra-group adjustments here, 35 and 15. So minus 35 minus 15. You can choose to write minus 50. It is still the same, right? So then, was there any other assets? Okay, we're having bank here, 100. And now we sum all of them. Plus, yeah, total asset. Now we move to equity and liability. Right. Now we start with what? Equity. Stated capital. And for stated capital, we are not going to add the two of them. Remind you, we said this the last time. We are going to only take the parent's stated capital, right? 700. Then we bring group retained earnings. Right here, we are not going to use this one. We've done some adjustments on it, so that's what we are going to bring here. A group retained earnings is in working 6, and we had 221. Then we bring our NCI value, which is in workings 4. We had 84. Now we add them. And then we come and then add up our liability. Payables, add them. 275 and then 55. Remember, we did some adjustments on it, right? We said we are going to what? Debit it, so we are going to subtract. So minus 15 minus 35 is still the same. So it is going to be 4275 plus 55. Then you have bank overdraft, right? It's 20 here, 0 plus 20, so it's going to be 20. You add them. All right. Put equity and liability here. We have. All right. So this is it for this particular question. And I hope you understood whatever we did today. So thank you very much for watching this video. Don't forget to like and also leave me a comment if you find this video helpful, so that it will encourage me to be dropping more. I will continue very soon with a subsidiary and an associate. Then we see the way forward from there. Thank you very much for this video. Thank you very much for watching this video. See you some other time. Bye. Hey, like that for me, okay? See you some other time.